here is 13.6. The next combination is combination QR. The standard deviation QR is 1. We calculated it 1.68 divided by the expected return QR 18.7. Then the next combination is combination QS. Combination QS. The standard deviation combination QS is 1.51. QS 1.51 divided by the expected return QS is QS we calculated it. QS expected return QS here is 17.29. Then lastly, combination RS. The standard deviation combination RS, we have it here, 1.77 divide the expected return RS, 14.86. These are the possible combinations and the mean variances. So begin with the PR 1.93 divide 13.6 is equal to 0.14. When converted into percentage, this is 14%. Next is 0.09. Next, 1.51 divided by 17.29. 1.51 divide 17.29. 0.087. Then lastly, RS 1.77 divide 14.86, 0.119. Now when converted into percentages, this is 8.9%. This is equal to 8.7%. It's equal to 11.9%. So those are the mean variances. These are the mean variances. Then based on these mean variances, we are to advise this company. The question reads, advise the shareholders of Mali Investment Holdings on the optimal project pair based on the mean variance criterion. Now, the most ideal combination or optimal project pair advice the most ideal project pair, as you can see, candidates is QS, and why? Because it has the least mean variance or coefficient of variation of 8.7%. That means the risk is lower. lower risk. Lower risk. It has a lower risk. Okay, 8.7%. So we've answered that question, candidates, and I hope you take time to go through it. I hope you've also seen that the question is simple to the extent that candidates required to just have the formula. If you have the formula for these requirements, like the correlation of coefficient, then you put down the formula, then check from the question if the inputs are provided in the question. Like candidates, you see correlation of coefficient is equal to the covariance of RS. The covariance of RS is given in the question. The standard deviation is also given in the question. That would earn you marks. All right. And before calculation of the relation of coefficients, it was important in this question for the candidate to first of all identify the possible project combination. Because we read in the question that this company had a limit of 15 million shillings to invest in various projects that we were provided the initial capital outlay. So it needed simple mathematics, like in project P. Project P required 9 million, project Q required 7 million. So combination of P and Q was not possible because 7 million plus 7 million, 9 million plus 7 million exceeds the limit of 15 million. That's why we didn't have that combination in our working. So you see, that was the initial starting point. First of all, identify the possible projects combination. And this is what now guided the student on how to calculate these other aspects, the correlation coefficient, the expected return, the standard deviation. So it's important, candidates, you practice. Look at these questions are just the same, but they are varied slightly. So if you get the concept, then it becomes easier for you to answer any question that may be tested in the exams. Thank you for attending today's revision session. In our next session, we are going to answer question number 4 that was tested in November 2020. Then we will again answer question 5. We are dedicated to providing all solutions for the CPA students appearing in the Advanced Financial Management paper. Thank you. God bless you. Bye-bye.
Hello learners, welcome to Manifested Publishers e-learning platform. Today I want us to go through advanced financial reporting. I am your lecturer, Mr. Okello Eric, and I want us to go through 2021 September sitting. We'll start with question 1 that requires your understanding of IFRS 10 and IAS 28 and even IFRS 3 business combinations. I'll read through. Question 1. We'll start with question 1 as indicated on the board. On 1st October 2019, H Limited acquired 80% of the ordinary shares in S Limited when the retained earnings of S were 335 million. On the same date, H acquired 40% of the ordinary shares in A Limited, paying 16 shillings per share. The acquisition of the ordinary shares in S was through a share exchange of 1 ordinary share in H for every 2 shares in S Limited. The market prices of H Limited's and S Limited shares as at the date of acquisition were 30 shillings and 18 shillings per share respectively. In addition, H Limited agreed to pay a further amount of 25 shillings per acquired share in S on 1st October 2021. H Limited's cost of capital is 10% per annum, and 1 shilling receivable in 2 years' time has a present value of 83 cents, or simply 0.83. H Limited has not yet recorded the consideration on acquisition of the ordinary shares in S. So, if not yet recorded, it is your role to record once you determine that consideration paid. And the consideration paid is by means of share exchange, not cash. Okay, then we have the draft financial statements of the group companies as that, which are as follows. Statement of profit or loss for the year ended 31st March. We have revenue, cost of sales, gross profit, distribution costs, administrative expenses, investment income, interest and dividend, finance cost, profit stroke loss before tax, income tax expense stroke relief, profit or loss for the year. Statement of financial position as of 31st March 2020, we have assets, non-current assets, property, plant and equipment, investment in A, financial asset. Current assets, inventory, trade receivables, cash and cash equivalents. Equity and liabilities. Under equity, we have ordinary shares of 10 shillings each, share premium, retained earnings. Non-current liabilities, we have 8% loan notes. Current liabilities, trade payables, and current tax payable. Additional information. 1. At the date of acquisition, the fair values of S Limited identifiable net assets approximated their book values with the exception of an item of land which had a fair value of 200 million above its carrying value. The plant had a remaining useful life of 10 years, in brackets, straight line depreciation at the date of acquisition. Depreciation on plant is classified as part of cost of sales. The fair value of the plant has not been reflected in S Limited financial statements. No fair value adjustment were required on the acquisition of A Limited. In addition, at the date of acquisition, S Limited had an internally generated brand which the directors of H believed to have fair value of 300 million shillings. The brand had an estimated useful life of 6 years. Amortization charge is classified as an administrative expense. So if you are given the classification of expense there according to functions, you must follow that when doing consolidation. Number 2, immediately after acquisition of S Limited, H Limited invested shillings 250 million in an 8% loan note of S Limited. All interest accruing to 31st March 2020 had been accounted for by both entities. S Limited also had other loans in issue as of 31st March 2020. So that is just information, because if you look at the statement of financial position, under assets, there is financial assets, and you can see under H 250, that is a financial asset that was acquired from S by H. It is already recorded, so you don't need to record. Okay, but it is necessary to inform the student. Number 3, after the acquisition, S Limited sold goods to H for 500 million. S Limited had marked up these goods at 25% above their cost. H Limited had 30% of these goods in its inventory as of 31st March 2020. That is an intercompany trading that you need to eliminate. That we call it common item between H and S that you need to eliminate during your consolidation. Number 4, H Limited policy is to value the non-controlling interest of S at its fair value at the date of acquisition. For this purpose, the market price of S Limited share at the date of acquisition is considered to be representative of the fair value. This is now valuation of non-controlling interest. According to IFRS 3, you're supposed to value NCI at fair value. And so we're going to see how to go about that. Number 5, impairment tests were carried out on 31st March 2020, which concluded that due to poor trading performance, the investment in A Limited had been impaired to the extent of 80 million. So when determining the investment in associate, you're supposed to eliminate impairment loss of 80 million. Number 6, S Limited paid dividends amounting to 400 million before the year end. So that is intercompany dividend that has already been accounted for. If you look at the income statement, under investment income, there is interest and dividend. And then we have number 7, all incomes and expenses of the 3 companies are deemed to accrue evenly over the 3 years unless as otherwise specified. The word accrue evenly should bring to your attention the timing aspect of acquisition. So go back to the question, look at when financial year ends. The financial year ends on 31st March 2020. The acquisition took place on 1st October 2019. So that means that our financial year begins on 1st April 2019 and ends on 31st March 2020. So we have to count how many months we have before acquisition and how many months we have after acquisition. Then the last one, other than the share exchange in the acquisition of ordinary shares in S Limited, there was no other issue of ordinary shares by the group companies. That is just information for your knowledge. Now, the required is consolidated statement of profit or loss for the year ended 31st March, that is the required A. And then consolidated statement of financial position as of 31st March, that is required B. So before you do all this, there are kind of workings that we have to go through to help you understand each and every information that has been demonstrated or that have been outlined in the question. So let us start to deconstruct this question. Okay, so the first thing that I'll elaborate on is timing of acquisition. Of S and A. So we draw this. The year begins on 1st April and ends on 31st March 2020. When is acquisition taking place? On 1st October 2019. This is pre-acquisition. This is post-acquisition. Now, the pre-acquisition here helps you to determine how many months these companies that are being acquired, we call them acquirees, operated on their own before being acquired by H. So post-acquisition here is going to help us know how many months you're supposed to include the incomes and expenses of the acquiree companies in the group financial statements. So if you look at the timing here, it's obvious that we have 6 months pre-acquisition and 6 months post-acquisition. Once you've established that, it is also important to talk about group structure. Group structure here is going to inform you the kind of relationship that H is having between S and A, and it is at that point that you'll establish the kind of accounting method you're supposed to use to account for S and A in the consolidated financial statements. So we have here H, this is the group structure, and H relating to This is S and this is A. So A is 40% and S is 80%. That means that NCI is 20%. From this group structure, we can conclude that S is a subsidiary because H is acquiring 80%, or simply 50 plus 1% on percentage ownership is in S. So therefore it is a subsidiary. It is meeting the definition of a subsidiary. And A is 40%. That is below 50% mark. And so A is an associate. So which kind of accounting method you're supposed to apply? We're going to say that, therefore, account for S using full consolidation method. And A using equity method. A is an associate, meaning that H is only exercising significant influence. What does that mean? It means that H is only participating in the financial and operating policy decisions. And S is subsidiary using full consolidation method. That means that H is having control, full control in S. So when accounting or consolidating the financial statements, do not forget to demonstrate this principle. The next thing that we need to talk about now is working. So I'll talk about working one. Working one, I'm going to work on consideration paid, which is in the introductory statement. It is not provided for, and in fact you are told that it has not been recorded. So we have to compute and then record. So can I compute consideration paid here? Consideration paid to acquire S. For A has been provided. If you look at balance sheet, there is investment in A and it is under H. That is what H paid to acquire A. And you can also prove it. You're told that on the same date, H acquired 40% of the ordinary shares in A, paying 16 per share. So 40% of the ordinary shares of A. How many shares do we have for A? That is 3 million. So 3 million, I'm just proving to you, divided by 10. This is shillings, I want units. So times 40%, that is the acquisition of these shares, then they are priced at 16. So if you do that, you're going to get 1920 million. So 3,000 divided by 10 times 0.4 times 16, you get 1920. So it has been already calculated and recorded. So it is the consideration paid to acquire S that you need to look for and record. Okay, so we proceed. We proceed here. The information on how to determine this is in paragraph 2. The acquisition of the ordinary shares in S was through a share exchange of 1 ordinary share in H for 2 shares in S. The market price of H and S shares at the date of acquisition were 30 and 18. So this is what I'll do. 1 for every 2. How many shares do we have for S? Go to the equity side. Ordinary share capital is 5 billion. So divided by 10. We acquired 80%. And then at what price do we value them? We value this consideration using the price of H because H is the one paying to acquire S. So at 30 shillings, what do you get? That is 5 million divided by 10 times 0.8 times 30 times 0.5. You get 6 shillings in millions. Shillings in millions there. Proceeding further, you're told that in addition, H agreed to pay a further amount of 25 shillings per acquired share in S on 1st October 2021. We are acquiring in 2019 and this consideration being paid by cash in 2021. Now, we call this deferred consideration because it is to be paid by H at some future date, that is in 2 years. And so to us, or to H, it is like a loan. So because it is payable, so it is payable in the future. So at this time we call it deferred consideration. This is by cash, by share exchange, then by cash here now. So cash, let me call it deferred consideration so that we see how to calculate it. It is paid by cash. How? 25 per acquired share, 25 shillings. So still a half times 5,000 over 10 times 80% times 25. 5,000 divided by 10 times 0.5 times 0.8 times 25. That is 5,000. If you proceed, there is that information provided that H limited cost of capital is 10% per annum and 1 shilling receivable in 2 years' time has a present value of 83%. That means that when consolidating this 5 million, you need to get the present value of what 5 million is, 5 billion is today, because this is what you're supposed to pay in 2 years' time. But what is the present value? That is why you're given the cost of capital. So I'll do what is called discounting. But before I do that, this is what I'm going to do to help you know how to record, because you're told H has not yet recorded the consideration on acquisition. So how do we record? So recording consideration paid 1. Recall that the par value is 10 shillings. H is paying 30 shillings. That means it is paying over and above the 10 shillings by 20. So this element of share premium. So under normal or nominal value, we're going to have 10 over 30 times 6. This will go to the equity shares, that is ordinary shares. That gives you 2,000. Then share premium, we're going to have 20 over 30 times 6, giving you 4. How do we record the deferred consideration? Deferred consideration, non-current liability will be 5 million times 0.83. So in short, what is the interest on this 5 billion? Its value is 5 billion times 0.83 is 4150. That means that the difference between 4150 and 5 billion is interest. And that you can see there is cost of capital, which is 10%. So that is like the same as interest. So interest on deferred consideration, and it is accrued. So interest accrued on deferred consideration is equal to 5 minus 4150. That is 850. Yes. So again, the total consideration paid here is 11. We'll use that in determining goodwill. Still proceeding, I want us to go to information 4, because information 4 it will help us get goodwill. If you don't determine it now, it will be a problem. Number 4, additional information 4, H limited policies to value the non-controlling interest of S, which is at 20%, at its fair value at the date of acquisition. For this purpose, the market price of S limited shares at the date of acquisition is considered to be the representative of the fair value. So we're going to value our NCI, valuation of NCI. So at fair value, of course, at fair value, according to IFRS 3 business combinations, we can value NCI at fair value or at the proportionate share of net assets. But at this time, we are using the fair value. If we get a question that requires proportionate share, we'll demonstrate that. So the acquisition was 1 for every 2 shares times 5 over 10 times now the proportion of NCI 20%, then it is valued at 25 per share. That is the fair value of equity shares of S. That is giving us 5,000 divided by 10 times 0.5 times 0.2 times 25. It's giving you 1250 C. Okay, 5 divided by 10 times 0.2 times 20. Should not be 25. I don't think it's 25. Let's look at that. The market prices of H and S shares at the date of acquisition were 30 and 18. Okay, so we should be using 18, not 25. 18. Okay, so 5 divided by 10 times 0.2 times 18, giving us 1800. We are not supposed to use 1 over 2 because this is not acquisition. We are valuing the NCI. So we get 1800 million. So this is the value of fair value of non-controlling interest that you're going to use you use when determining the goodwill on acquisition of S. Now let us proceed to now determining goodwill on acquisition and investment in associate. Those are major workings that you have to undertake whenever you are determining or whenever you are consolidating financial statements of a group involving subsidiary and associate. So let us start with, that is working 3, goodwill on acquisition of S. We start with consideration paid, shillings in millions, which is working 111. To that we add the fair value of non-controlling interest that we're going to pay them. We talk of fair value 1800. So the total consideration paid include CIFA of NCI is 12,800. To that we compare with fair value of identifiable net assets. Net assets of S. The net assets you determine from equity side of the balance sheet if not provided, and also additional information. In this case, we need the pre-acquired retained profit, that is the profits that S made alone before being acquired by H. We also need to determine the ordinary share capital of S. We also need to identify share premium and also identify if there was any fair value adjustment. Fair value adjustment means some of the assets owned by S gaining value at the date of acquisition. And so that is a benefit to S that must form part of the net assets. So ordinary share capital is 5. Pre-acquired retained earnings. Pre-acquired retained earnings, you are given in additional information, not additional information, in the introductory statement. You're told that on 1st October 2019, H Limited acquired 80% of the ordinary shares in S when the retained earnings of S were 5,335 million. On the same date, okay, H acquired 40%. So that is pre-acquired retained earnings. But recall that the timing of acquisition here also provides you with some information to help you get pre-acquired profits. Recall that we're only going to operate with S for 6 months. That means that the previous 6 months is a pre-acquisition period when S operated alone. So on top of the pre-acquired retained earnings provided, we're going to add the pre-acquired profits. So that will be 5335 plus 6/12 times the profit for the year was 2730. So 5335 plus 0.5 times 2730 gives you 67. Okay, so that gives you pre-acquired retained earnings. Then we have a share premium. Share premium is provided in the balance sheet, 2,500. Then we have in the introductory statement, information 1. At the date of acquisition, the fair values of S identifiable net assets approximated their book values with the exception of an item of plant which had a fair value of 200 million above its carrying value. So that is fair value adjustment on plant 200. Proceeding, depreciation on plant is classified as part of cost of sales, so we have to depreciate because they given 10 years useful life. The fair value of the plant has not been reflected in S Limited financial statements, so we have to reflect that again fair value adjustment when consolidating. The no fair value adjustment were required on acquisition of A, that is according to IS 28, there is no need because we don't calculate goodwill, we calculate investment in A. And then we have, in addition, at the date of acquisition, S had an internally generated brand which the directors of H believed to have a fair value of 300 million. The brand had an estimated useful life of 6 years. So again, there is brand that is being introduced at the date of acquisition. Brand of S, that is 300. So total fair value of net assets is 5 plus 6, 700 plus 2500 plus 500, giving us 14,700. Now, if you compare the fair value of net assets with the consideration paid, you can see there is bargain purchase. That means that we are paying less than the assets you are acquiring. Bargain purchase. Negative goodwill. So minus 12,800, you get 1,900. What is bargain purchase? This is an income to the group, to the parent. If you can read through the additional information, you can see you are not told about the impairment loss on goodwill on acquisition of S. That means that it was bargain purchase instead of the intangible asset of goodwill, which is the goodwill. Okay, so after that we go to what is called investment in associate, working for investment in associate. Equity method requires us to disclose only the investment that H is having in A, and also when determining the consolidated income statement, we look at the profit that H is gaining from A. That is what equity method requires you to do. The incomes and expenses of associate will not form part of the group, but just disclose the investment in A and also the share of profit that H is having or getting from A. That is the reason behind determining investment in associate. And what is it? It is an asset to the group, to H, not to the group. So what was the cost of investment? Cost of investment, we already demonstrated here why it is 1920. So shillings in millions, 1920. Then to this we add post-acquired retained earnings. Why post-acquired? Because H is interested in what it is getting in A, or its investment in A. So the post-acquired is simply the profits that H made together with A. How do we get that? The timing of acquisition is also going to guide you here. If you look at the income statement for A, it is a loss of 600 million for the whole year. That means that there is loss that will be borne by A for 6 months, then there is loss that will be borne by A for 6 months, A and H. If you look at the balance sheet, the total profits disclosed under retained earnings is 3.6 billion. So if we compare what we have in the balance sheet with the profits made, with the loss made for the year, this is what we're going to have as post-acquired. So the total profits is 3,600 minus the pre-acquired loss. The pre-acquired loss is 6/12 times 6. Recall that it is a loss. It's negative already. So the aspect of integers there will guide you. So it is 3,600 minus negative 300 times 40%. So 3,600 minus 300 minus 300, that is plus, that is giving you 3,900. So 3900 times 0.4, giving you 1560. And then we have impairment loss of 80. Impairment loss of 80 is provided in additional information 5. Impairment tests were carried out on 31st March 2020, which concluded that due to poor trading performance, the investment in A had been impaired to the extent of 80. And actually it is poor because there was a loss in that financial year. So we get our investment in associate, which is 1920 plus 1560 minus 80, 3400. Now, once you determine these two workings, you can also work on note 1. Still, there is depreciation and amortization. So amortization of brand, that is 300 over 6 times 6 over 12. This is 6 years. Then depreciation on fair value adjustment is 200 over 10 years times 6 over 12. So that is 300 divided by 6 times 0.5, giving you 25. And this is giving you 10. You're told how to classify. This is under admin expenses. This is under cost of sales. It is our work to demonstrate that when consolidating. Another thing that we can look at, additional information 2, is telling us about intercompany trading. Intercompany trading is a common item that is between two companies. In this case, it was S selling goods to, no, it should be information 3. That was information 2 is immediately after acquisition of S, H invested 250 million in 8% loan out of S Limited. All interest accruing on 31st March 2020 had been accounted for by both entities. S Limited also had other loans in issue. If you look at the 8% loan note in the balance sheet, it is remaining with 2 billion. That means it was having 250 billion loan notes, and 250 has been taken by H, which is demonstrated in the non-current assets. Under non-current assets, you can see financial assets worth 250. So it has been recorded. The information there is there to guide you. Number 3, after the acquisition, S sold goods to H for 500 million. S had marked up these goods at 25% above their cost. H Limited had 30% of these goods in its inventory as of 31st March 2020. So the intercompany sales that we need to eliminate accordingly, S is selling goods to H. Let me call it working 5 to guide you. Intercompany sales. Our role of doing this is to determine unrealized profit. Unrealized profit that arose as a result of some of these goods on this intercompany sales remaining in the stock of buying company. Recall that the buying company is buying them at invoice price, and if they're remaining in the stock of that company, they're remaining at that invoice price. Therefore, to avoid overstating the stock, please eliminate unrealized profit as you wait to eliminate the intercompany sales in both sales and cost of sales during your consolidation. So S is selling goods to H. Again, which kind of trading is this? This is called upstream transaction. That means that this unrealized profit must be shared between H and S during consolidation. So the amount of goods sold here is 500 million. And we are told that 30% are held in stock of hedge. So held in stock is 30% times 500, giving us 150. The next thing, S Limited had marked up these goods at 25% above their cost. So what is the markup? That is a quarter. We determine unrealized profit using the percentage margin. So we convert the markup of a quarter to margin. So how do we determine that? Our margin is always given by gross profit over sales. This is like gross profit. This is like cost of sales. Recall, this is percentage markup. This is gross profit. This is cost of sales. How do you get sales? Sales is equal to gross profit plus cost of sales. So in short, for you to get margin, it is the numerator you add to the denominator to get your gross profit over sales. So this will be 1/4 plus 1, which is 1/5. So with this, you are able to get your unrealized profit, which I'll say that URP therefore is equal to 1/5 times 150, which is equal to 30 M. At that point, we can now consolidate peacefully because quite a number of workings have been undertaken. So I'll proceed to consolidated statement of profit or loss for this group. We have the title there ready for us, shillings in millions. Shillings in millions. So some of these workings I'll adjust in the consolidation process. Revenue. Now here, this is where your timing. You must apply this that you indicated here. If you don't apply what you introduced the examiner to here, then it is of no use. So we are going to implement the timing of acquisition during consolidation of P&L because the incomes and expenses, unless otherwise stated, accrue evenly. So we apportion on pro rata basis. This is 25,200 plus 6/12 times 18,000 minus intercompany sales of 500. Cost of sales 15,120 for H plus 6/12 times 12,000 minus 500 plus, recall, you're told in information 1 that the depreciation on the fair value adjustment of plant is classified under cost of sales. So depreciation on plant that we just calculated under working, this should be working 4. Oh, this is working 3. Under working 3, we have depreciation on plant 10 million. So plus 10, then we put in bracket. Just to remind you, you can see that I'm not adding the incomes and expenses of associate. Why? Because with associate, we account for it using equity method, which means that you're supposed to just disclose the investment in associate in the statement of financial position as a non-current asset and the share of profit of associate to parent in the income statement. Full stop. The incomes and expenses of associate shall not form part of the group. But in the event that we have associate selling goods to H, then when consolidating the income statement and statement of financial position, you must eliminate the unrealized profit arising from that upstream transaction. I'm accounting for S using full consolidation method, which means I'm aggregating similar items and eliminating common items accordingly. We can proceed from there. So we get our gross profit here. And also think of investment income. It is provided. They can bring it on board immediately. Investment income. So 25,200 plus 0.5 times 18,000 minus 500. 33,700. 15,120 plus 0.5 times 12,000 minus 500 plus 10. We don't forget with URP, which is an opportunity costs arising from intercompany sales. And why do we add unrealized profit, by the way? We add it because the stock that we used to get our cost of sales was overstated as a result of including it in that under invoice price. So adding back the 30 unrealized profit is to bring the cost of sales to its real figure, because if stock is overstated, that means our cost of sales was understated. That is the logic behind that. So plus 30, 2660. We can determine that again. 15,120 plus 0.5 times 12,000 minus 500 plus 40. Okay, 2660. So we get our gross profit. Compare that with 33,700, 13,040. Investment income you are given to be 330. So we add, this is intercompany dividends and interest that are gained by parent from this acquisition. So 13,370. We compare this with operating costs. So here we have administrative expenses and distribution costs and finance costs. So distribution costs, administrative, and finance costs. There was impairment